week. Iran's armed forces announce end of military operations against Israel.
Gold price forecast. Gold US dollar hits over 2-month low under 4,300 late as US yields rally. Euro ECB hikes seen as growth headwind. BBSH.
Silver in steep downtrend with bearish engulfing. Live levels.
Gold oversold RSI at 29.9 in sharp downtrend. Live levels. Canadian dollar. Shorts jump despite recession. Rabobank. US President Trump expresses both Iran and Israel looking for ceasefire.
US dollar. Early summer rebound challenges bears. Societe Generale.
Good morning. Yeah, I saw that, Jim. That was crazy. Did you see the collapse in the Kospi in South Korea, though, at the Asia Open? Great. South Korea did a limit down. Morning, Denise. Don't forget CIA today. ready. We got zeros on the clock. I guess we gotta get going. Let's go.
Iran announces an end to military operations against Israel.
Yo, yo, yo. Let me remind you that trading is risky. Not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small. Stay humble. Focus on the long term. Never risk money you cannot afford to lose. Yo, yo, yo. Good morning. You're like, Wayne, you're drinking soda? It's 7:30 in the morning? Yeah, well, it's my lunch. So what's up? Oh my God, what a Friday, huh? So we got a major, awesome NFP, and therefore the market starts to price in a Fed hike, but of course we talked all about that as it happened and even before it happened, and then it happened. Then the markets opened and profit taking, huh? Usually a little bit early. Non-farm payrolls is usually not the profit taking. It's usually closer to the Fed meeting in June. But we all know this is a profit taking period. So is that the top? I don't know. Did you look at seasonality? So, could be rabbit, could be. Then Kospi, which is a South Korean stock market, which is very, very, very heavily tech related and correlated. Also, they woke up this morning, which is for us last night, and saw what happened in the New York session, AI tech sell-off. So Kospi had its chance. So they follow up with the NFP and limit down, which means the stock market dropped so fast they stopped trading on the stock market for 8 minutes. So anyways, it dropped a ton of bricks. I think came back and closed at only -8. So anyways, but that's their post NFP, because when NFP came out, they were asleep. So maybe everyone has adjusted their portfolios appropriately. Maybe that bloodbath is over. And by bloodbath, it's, like I said, if you look at seasonality, you might be able to spot a normal pattern in this time of year for such a thing as profit taking. But anyways, we got a lot of central bank meetings coming up soon. Do you think that has anything to do with it? Not just the Fed, but the ECB and the BOE and et cetera, et cetera, et cetera. Does that have anything to do with it? Does it have anything to do with summer coming up? Does it have anything to do with the elections way out in November? Well, those are all very good questions. So let's go through them together. Thank you for being part of the community. Thank you for being a subscriber. This is a collaboration between Traders and Traders Way. And I use both, of course. Terribly thirsty. And I'm coffeeed out. 7:30 in the morning. I've drank so much coffee. I'm coffeeed out. I'm just like, oh my God, I can't drink more. All right. So, Iran announces an end to military operations. So that sounds all right. But let's get a sit rep. Look at that, down 11, huh? What's up, Aiden?
Good morning. Let us get you up to speed. Today's market sentiment is currently flat and indecisive, representing a clear divergence from the broader risk-off trend established over the last week. This immediate neutrality is largely driven by a notable climb in the U.S. 10-year yield to 4.536%, which is exerting downward pressure on gold while the market digests the cessation of military hostilities in the Middle East. 1. Iran has announced an end to its military operations against Israel, and President Trump suggested both parties are looking for a ceasefire. Gold is currently under pressure, hitting a 2-month low below $4,300 as U.S. 10-year yields move higher. Meanwhile, the U.S. dollar is experiencing an early summer rebound, while the Canadian dollar is underperforming as we head into the Bank of Canada's policy week. Biggest movers right now, volatility index, NASDAQ 100 and Nikkei 225 are down. Ethereum and Bitcoin are up.
Just checking out the calendar. What else do we want to discuss today? S&P 74. It's not a terrible number. 7,500 was kind of where we were. So that's not a terrible number. Yeah, it's down quite a bit, 1.63. But I think relatively it's still okay. Now, if we're at 72 in a couple of days, yeah, all right, that could be ugly. VIX, however, is improved. 19 is bad, but we were at 21. We went from 16 to 21 on Friday. What was that, a 30% jump? Very bad. Yeah, very bad. So our risk radar, which had been +4 for quite some time, and then +3, and then suddenly -11. Did you see that on Friday? -11. Everything went bad. Which is, well, either a threat that you need to hedge or an opportunity for you to make money, which in the long run is a hedge. So I hope you took advantage of that. Bitcoin back to 64, I guess we can call it, 63.5. Okay, that's low, but it was lower. Gold still showing that it's related, that it's a risk-on asset. We've seen that for quite some time. We were almost $1,000 higher, and then the market cooled off. Now we're at 4,300. And that whole period, we went from sliding risk on down towards risk off. And now we're, as Aiden would say, decisively risk off. But maybe the worst is over, and that's the thing. A -11, okay, and a -5 is quite different. So are we on our way back to neutral? It's within reason, for sure. Look at the difference. Friday was nutso, huh? So volatility last week jumped 26%. On Friday, it was even higher, but now on Monday, it's come down, so that's good. But holy smokes, that is bad. Bitcoin recovering today, but down 13% for the week. Okay, gold down for the month, 7.5. For the week, 5. So that's bad. Kind of looking around. Stock market down after 9 weeks of up. Now remember what our seasonality says. Right around April, it should go up. So on April 1st, the stock market went up. It went up for 9 weeks. And then somewhere around July, you should take profit. Well, yeah, okay, we're still midway through June, but remember the discussion we've had. There's a window. Sometimes it's before, sometimes it's after. But after 9 weeks of up, and now you're already starting to think, oh, there's probably going to be some profit taking soon. Well, then it might just fit that mold. Oh, look at that. The put call ratio this morning is zeros. That's interesting because it was fine earlier. Maybe it just didn't load. So last week was a bad week. There is no doubt about it, huh? We went from a 6.6 to a negative 11.5. And I believe those are the closing scores. And then throughout, it was even worse. $92 on oil? Is that right? I thought it was higher than that. Huh. Things must have been moving just in the last little bit. We got this twice. Interesting. Oh, is that right, Jim? Yeah, it's the right time of day. I'll have to go over this with them. Whoa, don't click that. What did he just do? All right. I don't think we care about machine tool orders. Let's kill that. And then we can see which CPI is correct. 3.8. That's not right, but it's all right. He's got the same error on both. I'll have to clean this up. Looks like he's struggling a little bit on the calendar today. You don't need core. So we have producer price index, and we don't need this one because we have CPI. But then why do we have it twice? Oh, Japanese PPI, US PPI. Cool. Okay. Okay, the history is not lining up, so I'll have them work on that. All right. Looks like a pretty decent week, though. Just kind of going slow in the morning here. Um, we're caught a little bit, aren't we? Um, Bloodbath in Asia, bloodbath in the New York session on Friday, and now what? Yeah, I think we're caught in between. The tsunami comes in and then the tsunami goes back out. Now, in the long run, I'm a buyer of these dips. And that reminds me, the Council of Investment Advisors will be meeting today to discuss what we should do with our portfolio. Yeah, and there's a few other opportunities for us to consider in the future for allocation. I'm not sure if we're going to talk about that today, but we definitely could talk about talking about it. Wonder if this Aussie's going to continue, huh? Be interesting with these yens. Down on the yens is risk off. So that's where it gets very interesting. That's what I mean, like tsunami in, tsunami out. That is this short-term trend, as you can see, is very, very red. But the long-term trend is very, very green, and we're at that one standard deviation. So I wonder if the bloodbath is over and we enter recovery mode. Now, again, with seasonality, I would say if it does recover, it's not going to be a long-term recovery. Yeah, but could we recover some of those losses and then tread water until the Fed meeting, for example? Sure. Neutral S&P. Yeah, there's that pullback. Yeah, but you can see the significance, huh? It's more than one standard deviation below mean. Yeah. Bitcoin recovering from that drop. And he says that would be probable. Yeah, at least reasonable, right? Reasonable, probable. Yeah. Yeah, recoveries. I mean, the price is low, but compared to what it was, oy vey. And yields rising. Whoa, yucky. Yuck. So I've been trying to add some political stuff here so we can track the upcoming election in the United States. But then you get like Armenian elections. Sorry, Armenia. Nothing against Armenia. I know an Armenian. He's a nice guy. Probably don't need it in our thing. Trump out as president. Okay, silly. Yeah. So I have to teach Aiden what we want versus everything else. I mean, some of this is, I guess, slightly interesting, but not really important. Russian parliamentary elections, probably don't need it. Quebec general election. Hey, who won that hockey game the other night? It was 10 o'clock or 10:30, and all of a sudden, oh my God, 4 goals in like 2 minutes. I'm like, overtime? I gotta go to bed. I can't stay up beyond 10. Matthias says, would you walk us through the usual process of taking a trade? This is what we're doing. Matthias, this is the whole point of traders. Right now, we're going through market sentiment. See? Sentiment. The next tab, fundamentals. So, Matthias, my friend, King Matthias. Hey, have you reviewed the Commitment of Traders report yet since it came out on Friday? If the answer is no, then how do you know what to trade? That's an obvious thing that we should be doing on a Monday morning. Now, honestly, you should have done it over the weekend. But, I suppose macro, yeah, which I haven't promoted in a very long time, though, have I? But it's over there at Investor Bootcamp. But yeah, but still, like a basic thing is it. On Friday, we found out what the institutional investors are doing. So I would have to start that like over the weekend. You would have been analyzing your charts. You would have been analyzing seasonality, and you would have updated your bias with institutional positioning, right? Like that would be basic. You know the seasonality, you know the positioning, and you have analyzed the change in sentiment in the market. So that's all part of the usual process of taking a trade. Now, what most people do is they just trade euro dollar every day, and then they look at pound dollar, and then they look at, Kiwi CAD. Well, that's no way to trade. So this is why we're going through the process of taking a trade. But again, the assumption is that you've already done it. Well, Sven, we do track the put call ratio. Yep. And inside a trend radar is our version of an implied volatility analysis. I'll have to figure out why he's taking so long to load these things. He's messed something up. But hang on. Yeah, see, something is a glitchy. Watch, it came back. See, I think he's doing it twice or something. I'm not sure why he's slow. Boom. Now it's back. All right. So, okay. Right on, Sven. Yeah. What's he doing? All right. I'll put this on my to-do list. Why is it, coming and going? He's doing something weird in the background. When I say he, I mean Aiden. But anyways, so we have Cody and Aiden on the team. So it's Wayne, Cody, and Aiden. And it was funny because now that we've moved Aiden into our own large language model that's not connected to any other LLM, like there's zero ChatGPT, there's zero Claude, it's just us. It was funny because over the weekend, Cody says to me, I ask a question and Cody says, "This is not my response. This is what Aiden says," right? And he writes it down. Because Cody can talk to Aiden anyway. So he knows, for example, when I ask an economic question, he's like, "Well, this is not a question for me. This is a question for Aiden." And then he comes back, "This is what Aiden said, but it's not my opinion. I'm just a coder." And I get, so now there's literally three of us in conversations, which is pretty wild. But anyways, going back to this, this is essentially a form of implied volatility. Yes, it's a measure of trend, but a measure of trend would just be rise over run. So you see three lines here. Okay. A steep green line, a less steep green line, and then a steep down red line. Okay, those are calculated by the rise over the run. Okay, slope. But notice that they're in a shaded area, each of them. And that's standard deviation. It's implying the level of volatility from the past into the future, which is an interesting way of doing it, right? Which is, again, a standard deviation calculation. It's the square root of the variance. So you have to average the variance over time and then square root the average variance to get the standardized variance. And variance is similar to deviation, right? So that's where we say, ooh, one standard deviation below the long-term mean, which is an implied support. Okay? But it's a good way to burn through a bunch of charts really fast and see what's going on. Neutral, 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 bullish, bullish. Okay, good. We're very cautiously bullish, right? But moving on to Matthias's question, even though Matthias hasn't responded to my response to Matthias's question, we are figuring out what to trade. Most amateur traders go to their charts to look for something to do. That's why they fail. In this case, we're looking at why we should be doing things first. So most of this data is fundamental. This is why we put it on the Fundamentals tab. Now, some of this data is related to charts, but most of this is macroeconomic data and differential analysis. So as of now, we're very bullish on pound Kiwi for some reason. All right. We're also very bullish on Euro Kiwi. Oh. We're also bullish on Aussie Kiwi. Oh. We're also very bearish on Kiwi dollar. We're bearish on Kiwi yen. We're bearish on Kiwi Swiss franc. We're bearish on Kiwi CAD. So, Matthias, what do you think you should put on your radar list in the usual process of looking for trades to take? Knowing that this is mostly fundamental and a little bit technical, because we are looking at momentum and trend in this number. Okay. Kiwi dollar, pound Kiwi, Kiwi yen, NASDAQ. Kiwi Swiss franc, corn. Kiwi CAD, Euro Kiwi. What do you think? Matthias. There he is. Yeah, okay. So we know that you may not want to even look at euro dollar today, even though it might be your favorite or someone else's favorite. Yeah. You see? So you're going to start there. We've just thinned the herd. You can look at everything in the world by flipping through charts, or you could just jump straight to the Kiwi pairs. Okay. Somewhere between June and July, we top out in the S&P 500. Okay. Look at, again, the implied volatility is the range, the gray area, not the dotted line. And June to July, you see the down? June to July, you see that there is a reasonable decline in the S&P 500 over the last 20 years. Okay. And you can see it's labeled the standard deviation band. June to July often have a significant decline. Then it sort of recovers a bit and then drops again. When? In that period, August to September, September to October. Even in the good years, you see, when you look at here, even in the good years, okay, September to when? The third week of September, even in the good years, is a dip. So it drops for 3 weeks. Remember, and I've been teaching this forever, third week of September. Sometimes it's third week of August, but it's been shifting and shifting more and more towards third week of September. Oh, wait, is that a Fed meeting? Yeah, shut the back door, right? How about June? There's typically a decline in June, or often a decline in June. I'm trying to get this a little more accurate. Okay. And then right around July 1st, okay, I guess that's probably easier. Is this what I wanted? No, but anyways. Okay, you see June, recovery, and then collapse again. So the light kind of green is our prediction. Down in the first quarter, recover in the second quarter. Okay, down to flat. Okay, there's a peak in July. Think about it. There's a decline and a peak in this June-July period. July 1st. Now, we don't know when in July. I have my experience to help me, but we know somewhere in July, and what I taught you last week is it could be a little bit before July, it could be a little bit after July. We call it a window, the window of opportunity. In this case, somewhere around July, the S&P 500 hits a peak. What happens when you hit a peak? Profit taking. So has it started? Well, what we see is somewhere in May there's a peak, decline in June. Then somewhere in June it can rally back up and then collapse for... This is a 5-week month, isn't it? So if you think about this could be 5 and then 4. And then I think this is third, right? 5, 4, and 3. That could be a 12-week of sideways or down. But none of this should be, I don't know, surprising. NASDAQ starts to peak in May and starts fizzling out. Wait, where did it go? Okay, fizzling out. And in this June-July period, we top out August and September. This is for NASDAQ. Okay? So, look, the red line is what's actually happening. This dotted green line is what we estimate to have happen. A decline in the beginning of the year, and then a long recovery, and then a dip in June and sort of a recovery a little bit in July, but not really a higher high. And then from July to August, down. From August, September, down. And somewhere in September, we bottom out and we start buying. So September to October is up. October to November is up. And then we give back in December. So somewhere in December, we take profit. We had all this drawn out on January 1st. Now, we're using 20 years of data to give you the general shape or the implied path, the glide path of the NASDAQ 1 year in advance. So we said it'll start out with a down period and it dropped. Then we said it would recover and go up for an extended period, and it has. Then a long protracted decline, and then a big rally up into the end of the year. So far, we have been right. Despite the war. Now, maybe the magnitude is adjusted, but even then, not really, because the decline in the stock market this year was 10%, which is more profit-taking than war-related crisis. So pretty good general guide. So our big question in choosing what to trade today is whether today is a risk on day or a risk off. That's why we have that data. We're still doing longer term analysis. I believe the 30-year is when the market open is going to be quite a bit over 5. I think this is more like 5.7 right now. And things have adjusted a little bit, which is interesting. But Aiden's reading this as on hold now. There was a little bit of a hike in there. I wonder if this will change throughout the day. Ha! Wait, I'm going to keep refreshing this. Maybe I found a glitch here. Okay, that's 2 hikes in a row. It's interesting. I might have to teach him. Okay, that's 3 hikes in a row. 4 hikes in a row. So he might, okay. All right, I'll look into that today. Okay, that's 5 in a row. Okay, that makes sense. So when you analyze this, it's suggesting that the market is pricing in a Fed hike. And that's what happened on Friday. We talked about it before the news. We talked about it as the news came out. We talked about it after the news. And I actually used it as a lesson to teach Aiden. So on Friday after the news, I sat down there and we created a almost like a lesson plan for Aiden, where I'm teaching him the relational components of macroeconomics. And so I said, why did the stock market fall? And he gave his answer, and I said, do you think it's related to non-farm payrolls? And he said, yeah, the stock market collapsed because the unemployment rate stayed at 4.3. I said, seriously? Really? The markets collapsed because the unemployment rate didn't change? And he's like, well, So we had this conversation and we were working on this process of, like, think of it as dominoes. This happened, this happened, this happened, this happened. Therefore, the stock market fell. And so what I'm now doing in his macroeconomic analysis is adding behavioral finance to understand how opinions change, which is not necessarily economics, is it? Because the economics haven't changed. What people think the Fed should do has changed, which is behavioral, not macro. So I went through that process and said, no. It was the greater than expected headline non-farm payrolls number. See, I taught him that the unemployment rate is more important than the NFP number. So he's like, well, that's the most important. But that's not necessarily what moves the market. It's most important for analytics, but for market sentiment, the higher number. Okay, so more jobs than expected. So that's good. So why is it bad? So then I walked him through that process. I said, okay, the higher non-farm payrolls, higher than expected, positive differential. Then I said, hey, tell me about the yield curve. Analyze the yield curve and tell me what your opinion is. And he started to come up with some nonsense. And I'm like, Hayden, you're already doing it. You're already analyzing it. You don't have to do it again. You've already put your opinion down. He's like, oh, you're right. Yeah, okay. So I said, well, you're already analyzing it, so tell me what you think. And he says, well, what analyzing the yield curve and the changes in the yield curve, it's suggesting that institutional investors are preparing for a rate hike in the future. And he's like, oh, that makes sense. So the high number might increase this probability. And I said, yeah, so you're going to pay attention to this. So if the yield curve continues to change, and of course it did change later that day, it suggests the same, that the money is flowing in such a way that the logic behind someone doing it would be that they can get a higher interest rate in the future. So the value drops today. Okay. Then I said, well, the next thing that should be on your mind, Aiden, if you're doing not just macroeconomics but behavioral finance, is if you think the Fed might raise interest rates soon, and the consequence of that, or what's the consequence of that to the stock market? And then he gave some answer, and I'm like, well, why? Tell me why. And he gave me some nonsense. So let me tell you what I told him. Let me get my drawing tool, my EpiPen. Okay. So this is me actually teaching Aiden our large language model. So now that he's told me that he's read the yield curve and he believes the logic behind investors doing this is that in the future they can get a higher interest rate, therefore prices are falling. Okay. And then I said, well, what impact would that have on the stock market if interest rates rise? So I said, well, if you're a large corporation you'll have to pay a higher yield on bonds. If you're a small and medium-sized corporation that rents equipment, rents vehicles, leases buildings, these costs will also go up. So I said, okay, let's take this into consideration. Okay, the expected return of a stock is equal to, right, the risk-free rate of return plus the expected return for the market minus the risk-free rate of return. Okay? Literally typed this out. And I took him to the formula and I said, so your costs go up. So let's do it this way. Okay? The risk-free rate of return. The yield on the 10-year. And that goes up, the value of the stock falls. Because they have to spend with the same amount of revenue, and this is literally what I'm teaching them, with the same amount of revenue, if the cost of borrowing goes up, it's a cost of doing business. So if it costs you more to do business, but your revenue stays the same, you're less profitable, therefore the value of your company falls. You're less valuable. You have less profit because your expenses went up, but your revenue stayed the same. You're less profitable. And, so your profit falls, the value of your company falls. And we can do that through a different valuation model called discounted cash flows, which also points to a lower value of a company. But nonetheless, mathematically, the value of a company falls. So we went through and explained all this to him. So if that goes up, the stock market is mathematically should lose value. Even if and I said, yeah, but if it's also occurring when the economy is slowing down, then also future revenue can fall and your profitability could fall too. And therefore the stock market falls, the valuation really is what it is, falls even further. So I said, so could you tell me when that decline would occur in the stock market? And if so, how would you do it? And he's like, well, I'm not actually sure how I would do that. So I said, well, you have the seasonality radar. So imagine now you're reading the yield curve and it said the market is positioning itself in the treasury market for a decline in the stock market. Well, not really. They're preparing for a raise in interest rates, making the stock market less profitable, suggesting a decline in the stock market. I said, well, take it one step further then, Aidan. You have seasonality. So what if you were looking at it and you knew in the next 8 weeks there was a higher probability than ever of a decline or sideways move in the stock market? What if you could see, and I'm just going to leave it at euro dollar, right? What if you could see we're here now and this is next? Couldn't you suggest that the treasury market is building their position for that decline? And that you could then see into the future based on seasonality when the decline usually occurs? Could you use that in your analysis and say, well, in the next few weeks, I expect a decline. Meanwhile, institutional investors in the treasury market are already building a position for the decline. Couldn't you put those two things together? And he's like, oh, you're right. I can now analyze for the timing of the decline, not just that institutional investors and treasuries are building up for a hike but that the hike makes companies less profitable, and that when they're less profitable, the stock market falls, and the stock market falls somewhere around July. Whoa! I'm having these conversations with the machine. Isn't that crazy? This occurred Saturday morning. I worked 12 hours on Saturday from the morning to the evening with almost no breaks for food. So I'm just teaching Aiden macroeconomics and behavioral finance. So he's getting that Harvard degree and he works for you. What do you think about that? And his whole logic is about what would Wayne think? What would Wayne do? Yeah, if you're in learning mode, most people here have gone through Investor Boot Camp. It's $88 a year and is 100 hours of lectures, not babble like I do here. Lectures, like university courses that I teach. Yeah. Most people, I never promote this, but most people here have gone through it. At some point, and some point soon, like probably over the summer, I'm going to move this over to TradeRs, and you can pay for it there. The other thing I'm working on is, and sometime soon, you'll be able to get the chart templates at TradeRs. I'm making a process for it right now. So sometime very soon, you'll be able to do that. And I don't know if you guys noticed. Did you guys notice? Let me move this. Did you notice this? We have a rewards program coming. So not only am I going to give you all those other updates or upgrades that I've just told you about, courses, right? Templates. There's other things coming, but also we're launching a rewards program soon, very soon. Yeah. So most of you here that are paying for our highest tier, our highest level of subscription, most of you will pay half as much. Yeah. No, I won't delete Investor Bootcamp. No. Yeah, like Jim, for example, the way I envision it is you would probably pay for the lowest tier. So you would pay for the essentials level, right, Jim? $29 a month. But based on our rewards program, you would have everything on lock. So you'd get live, but you'd be paying for essentials. Right, Jim? So imagine that. You're paying $29 a month and you're getting the live tier subscription. Now, someone else might, let's say, I think most people will be paying for data max, but getting live unlocked. So the way it goes is as you, as we call it the active trader program. I haven't launched it, so I guess I shouldn't tell you too much. But just imagine the more active you are as a trader, you unlock the benefits as you go along. You level up with your activity. Yeah. And the nice thing about that, Jim, because we know in other iterations, well, in this case, it unlocks things automatically without sort of human intervention, right? So versus like me having to go to a PayPal account and email your PayPal, that takes a long time. Versus it just like, boom, you've leveled up. Unlocking, unlocking crypto. Yeah. So anyways, should be a ton of fun. Yeah. Yeah, and by the way, it's already built. We're just in testing mode. So my guess, almost everyone is going to pay out of their pocket 50% less. Some of you are going to get it for nearly free. Okay. And, okay, so let me say that again. In the rewards program, most people here are going to get TradeRs for at least half price, maybe 80, 90% off out of pocket. Plus, you'll get a rebate on your spreads so that your trades are cheaper. Plus, you'll get an equity boost to make your cost of leverage cheaper. Plus, you'll have active trader status. Plus what? I'm missing one more. Oh, plus you'll get all my chart templates. And I think there's a couple other pluses. So cheaper trading, cheaper leverage, cheaper subscription, and additional benefits. Whoa! Yeah. So ridiculous for sure. Cool. All right. So let's go back to the fundies. So I pointed out seasonality, pointed out the bond radar. I pointed out behavioral finance, which I'm teaching AI, Aiden, to do for you. And somebody asked, "Hey, where can I learn like the behavioral finance stuff?" Ultimately, my vision is Aiden will teach you. I don't have that built yet because I have to teach Aiden first. And when he knows how to do it, then I'll have him be able to communicate or even teach you how to do it. So that's in the vision. All right, so it's Monday, guys. We're still trying to answer the question, what do we want to trade? Okay. What are the steps to setting up a trade? We're still figuring that out. Right now we know Kiwi doesn't look very good as far as our quantitative analysis of macroeconomic data. On Friday, we got an update, and it shows the market is net short the Kiwi dollar. Okay? When you look at all the institutional investors, they're all sellers, or the majority of them are sellers. Okay? They're sellers. Let me say that again. Institutional investors are selling Kiwi pairs. Right, Matthias? Well, Matthias, that was part of our analysis to get to the conclusion of which pair. Because we went through and we had a different order. We were, right? We were aggressively selling Kiwi at different rates versus the other currencies. So we have to say, well, if we're bearish on Kiwi, what are we bullish on? And of the things we're bullish on, which are we more bullish on? So you have to know two things. Are you bearish on Kiwi? Yes. Great. So what are you bullish on? Which one, and then most bullish to least bullish. And we've already done that. Now, why are you more bullish on one thing and less bullish on another thing? Well, that's where macroeconomics and quantitative analysis comes in, and we're comparing GDP to inflation to unemployment, okay? That kind of stuff. And that's where we got those plus or minus scores. Part of that is institutional positioning and flow. And so the market is net short Kiwi. That's it. Institutional investors are shorting Kiwi. Now, what did they do last week? They heavily shorted Kiwi. They got more short. They got a lot more short. Huh. Now, what else is interesting? Short Bitcoin, but they were buyers last week. So we had that big drop. Maybe now what? Some are buying the dip? Maybe. Is this a time of change? I don't know. If I were you, if I were me, I'd look at this and say, I wonder if they're going to slowly go from net short to net long. Did we just find the bottom? Because that's a lot of buying for bears. So are bulls going to overtake the bears? I don't know. Check the seasonality. When does that typically occur? Now you're doing behavioral finance. It hasn't happened yet, but if it happened, when would it happen? That's a different question than what happened last week. What you're thinking is what's going to happen in the next 4 or 5 weeks. Now you're at the behavioral finance level. Okay? BF is your BFF. I just made that up. It's amazing. Okay. What about currencies specifically? Okay. Bullish, Mexican peso, and they were buyers. Oh, dang it. I got knocked out of all my peso trades for profit. Like, what did I make? 95 billion pesos. But they're adding to their position. Aussie dollar. Okay? Not adding to their position. Okay? What about pound? Not adding to their position. Sell the USD. That's risk on. Don't! but they are buyers of USD, which is risk on. Okay, they're buying safe haven. Uh-oh. Uh-oh. If you remember Teletubbies. Tinky Winky. Okay. Bearish on CAD and selling more. They're adding to their short position. Yen adding to their short position. Kiwi adding to their short position. Swiss franc adding to their short position. Uh-oh, SpaghettiOs. So what do you think, Matthias? Well, this is all before Friday's collapse. So this is the most recent data, but we don't have, right? This was Tuesday, not Friday. But in risk-on scenarios, or moderately risk-on scenarios, the market was adding to peso, but they had some concerns in the market. They were buying some dollar. Okay, risk-on, sell yens. Risk-on, sell Swissy. Aussie's neutral. Cool stuff. So you're like, well, Wayne, it's hard for me to do this on my own. You're like, well, that's why I had this built. Mexican peso, very bullish. Dollar, very weak. New Zealand, strong bearish. Australia, strong bullish. Japan, strong bearish. Canada, strong, well, bearish. Okay. Oh, well, that's helpful. You're welcome. Now, what should you be trading? Aussie US dollar, Aussie Kiwi dollar, Aussie Japanese yen, British pound US dollar, British pound Kiwi dollar, British pound Japanese yen. All we're doing is the institutional divergence. This has nothing to do with charts. This has nothing to do with macroeconomics. It has to do what institutional traders think about the charts and think about the macroeconomics and how they're placing their bets. Do you want to be aligned with them or against with them? Aussie bullish, Aussie bullish, Aussie bullish, pound bullish, pound bullish, pound bullish, but also look at the congruency of sell dollar, sell Kiwi dollar, sell yen. There's no opinions on here. It's just the divergence of institutional capital stock and flow. Otherwise, currency pairs with strongest institutional positioning spreads. Are you trading the spread in institutional positioning? Oh my God! Come on, Matthias! Damn, boy! So now we're like, well, maybe Aussie Kiwi, pound Kiwi? Put them on your hit list, Matthias. So now those are good places to start. Whoa. Gorgeous. Anyways. Start there. But that's not everything. It's not necessarily doing charts or macro. It's relying on what institutional positioners are doing based on their charts and their macro. So not everything. We have our macroeconomic scores, which is something. And now we have our COT, which is also something. You might, if you want to take a gander at right seasonality, you can do that. But like when we go to the table view, pound Kiwi, we've already looked at institutional positioning. We've already looked at seasonality. We've also looked at the charts for trend and momentum. We also calculated we made an index of pound and an index of Kiwi and then compared the two. We also compared GDP between the two economies, inflation between the two economies, jobs between the two economies, and rates between the two economies. So we've actually already done it. You see? We still haven't looked at a chart, Matthias. Because if you're looking at Euro Aussie, it's okay if you're a buyer. Okay? Oh, you know what I need to add here? Ooh. Not just rates, but implied rates. Oh, snap. Oh, snap. I'm going to do implied monetary policy. ECB is going to raise interest rates, right? How do I know? Well, there's two ways. We can go to the prediction radar, and I can tell you what markets think. So we go to interest rates. ECB rate, June 2026, in 3 days, 99% chance the ECB raises interest rates. Dude, look how easy that is. But I don't like looking at that. I mean, this is interesting. I don't know. Whatever. It's a prediction market. There it is. I can also do my prediction differently because this is counting number of trades, right? Number of bets. We could do it differently and go to the go to the rates radar and look at the yield curve of the ECB. Shut up. Shut up. Shut your mouth. Shut your mouth. What? Yeah. So we're at 2, and there's 100% chance of a hike, which is better than 99, based on how institutional investors are investing their money into treasuries, based on yield curve analysis of European treasuries. Institutional investors have already priced in the hike with their own bets. Oh my God. So it just occurred to me because I built this a month ago. If I have this for the majors, and I don't know if it's 100% complete, so I'm going to have to do an audit on this. But if I have this complete, shut up, then I can add it here to say what's the current interest rate differential, but what's the differential in implied monetary policy by the Bank of England and the RBNZ? What's the difference in implied future monetary policy between the ECB and the RBNZ? What about the RBA and the RBNZ? Dude. Oh. That's cool. Again, because now we're adding future guidance. I love it. Please don't let me forget. Somebody take a note to make sure I don't forget, because that is how it's done. Like, one day I'm sitting there and snap, and I can make it happen. And I'm like that too. You know, like I come downstairs in the morning and my wife and kids want to talk, and I'm like, whoa, 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 whoa. My head is just buzzing right now, and I just have to sit down before it's gone. I gotta write it all down because I got 15,000 things going on here, and I don't want to get distracted. I don't even like to stop to eat. So don't let me forget, because I'm in the middle of a webinar and that could just fizzily fade onto the next great idea. Okay? Who's going to take responsibility to remind me? Implied rates. The implied monetary policy by analyzing the yield curve of both British and New Zealand treasuries. Thank you. Thank you. All right. And so, whatever. You can do all this. Whatever. Wayne, what do you think about gold? I get that question every day. That's what I think. There you go. Cool. Dude, what I think about gold, I got so much stuff. Yeah. All right. I want to move to the next now. Oh, yeah, you sent an email. No, remind me tomorrow or this afternoon. Yeah, emails. Emails. All right. There's your index radar, because this is only looking at charts. Are we short the Swiss franc? Institutions are. We already know this. We covered it in our COT. I think we're moderately bearish on Aussie, but we're very bearish on New Zealand dollar, right? Well, what's happening right this second? We have permission to sell this. This is probably, we're not so sure. I think it was quite neutral, but we're definitely short this. What about yen? Well, we want to be short yen, but yen is strong right now. Definitely being impacted by Asia risk off. Hey, dude, the Kospi was limit down today. Asia's not happy. They're still suffering through the AI pullback. But is that your opportunity? What about tomorrow? What about next week? What about all summer? Okay. You got to pay attention. We're not happy with CAD, but CAD's strong right now. Cool. Crypto recovered after a massive collapse. Energy up. Metals flat. Treasuries flat. Europe flat. Risk off. Asia down. US stock market down. So, how would we say it? Risk off, risk off, risk off. Energy up is a risk off scenario under these, right? And crypto up is the only, but I think, is it a dead cat bounce? So, Wayne, help me translate this into trades. Okay. I think we were interested in buying pound. Yep. You want to keep your eye on pound kiwi, wasn't it? Now, remember when we were analyzing things with the institutional positioning, remember that was before the recent change in market sentiment. You're just using that as the bigger picture. Don't get overly where we were looking at institutional positioning and it's like a long Aussie, short Kiwi, long pound, right? That kind of stuff, right? Well, pound, yeah, that's pretty good today. Aussie not having a good day. Well, things are a lot different now as of Friday than Tuesday of last week. We have Friday of last week impacting us today, but based on institutional positioning, that was Tuesday of last week. So it's not that it's wrong, it's that it is what it is. We know what institutional investors were doing. And now if that comes back, you'll be able to spot it. Today, what do we notice? Aussie week, Aussie week, Aussie week, Kiwi week, Kiwi week, Kiwi week. So you could still be selling Kiwi. We just thought we would be doing it differently. All right. Well, it seems like even institutional investors are still selling Kiwi. Euro is weak right now. I would suspect that will change, especially if we enter the regime of higher interest rates in Europe. That's one possible outcome. If suddenly we have a monetary policy at the ECB that suggests interest rates going up and continuing to go up. We already have it all mapped out based on the European Treasury market. So if they raise this month and then pause and then, or this week, and then next one after that is a pause, and then the one in the fall, there's another hike. Cool. But right now, Kiwi is weak. Oil's going up, so CAD is benefiting. Will that continue? I think that's very headline driven right now. Is it truly supply and demand? Well, we know we're short on supply. Demand is strong, but the up and down of the Canadian dollar is related to the up and down of oil, which doesn't seem to be supply and demand driven. Seems to be driven by exogenous shock and headline news, which makes it very tricky, in my opinion, because it's hard to be informed of every piece of every headline. Like, even our headline radar can't catch every headline. We only track things that I think are related to investing and trading. It gets it, but it's possible to, like, I don't know, Israel agrees with something. I don't know. It's hard to trade when things can change direction on a crack of a whip, not logic, intelligence, so on and so forth, right? So anyway. So Canadian dollar strong now, here, but also here, and here, and here. But I would guess that eventually, and that could be later today, later this week, later this month, later this year, but I wouldn't be shocked if WTI stayed below 100 and worked its way down. Well, hell's bells. That would change the Canadian dollar strength. So anyways, maybe that makes it easy for you. These are the bullish things. These are the bearish things. Here's the other thing. Plus 5.32. Negative 2.25. Plus 1.23. See, it organizes it by conviction. Moderately strong, moderately strong, moderately strong, moderately weak, moderately weak, moderately weak. Hey, man, it could be a heck of a lot worse, huh? Oh, for sure. But that's what position is all about, okay? Over the last 30 days, we've been buyers of US dollar. That's just a fact. You can see it here, 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 and you can see it here, here, and here. Dollar strong brings Bitcoin down 22%. Dollar strong brings silver down 11%. Dollar strong brings down gold 7.5%. You see the relationships? We're not creating the relationships and displaying it to you. This is just individually, factually, what has happened over the last 30 days. There's no manipulation of relationship here. We're not twisting things to show a correlation. This is the correlation. This is the biggest correlation. The biggest thing in the world is dollar's been strong. That's it. Nice to know. Cool, right? Yeah. So what have you decided to do? You looking at swing trades? Swing trades are still sell Kiwi. So I think maybe that's where I'd go. It's not weak now. I mean, yeah, no, it's weak, but I want it to be continue to be weak, not just today. So let's start with today and look at New Zealand. And what's the best trade? Kiwi strong versus pound. That's not what I'm looking for. Kiwi strong versus euro. That's not what I'm looking for. Kiwi strong versus Swiss franc. Not what I'm looking for. Okay. Okay. So I'm looking for the flip, guys. Okay. If it doesn't flip and Kiwi moves down, that means today is a big risk on theme. But we just went through a bloodbath, so even if that happens, I don't want to get seriously involved. My job isn't to get in the middle of the fight. My job is to survive the fight. So if Kiwi is long-term short, but today it's short-term long, then I stay out of the mix. When I wrote the book, Strategic and Tactical Forex Trading, the strategy is my bias. The tactics are my day trading. So if we go through and look at institutional investing and macroeconomics and all these different things, and we say we're long-term short Kiwi dollar, I'm not interested in being short-term long. What I'm interested in is watching a strong Kiwi turn weak and get short the Kiwi dollar long-term. I'm long-term short. So it might be strong today, but weak for 3 weeks. Awesome. That's what I'm looking for. That's how I'm making my money. Strategy first. Cool. So I got to finish building out the coaching portal for the other coaches. I think that's going to be easily done now. Need to build in courses for you guys, as I talked about earlier. So when you're in our loyalty program, our active trader rewards program, that could be something that you can access. Plus, I also want to have a download section for our chart templates. Recording section. This worked. So it hasn't been working on the other thing. And you don't know what I'm talking about, but I'm talking to myself. The other thing wasn't working, but I got this one to work, which means I think I know what the other thing needs to be done. So the very, very good news is I believe we got our recordings section functional. Now, Friday was a bit of a shit show because I think Aiden made a bunch of mistakes on sending you information on where the webinar was. And trust you me, my heart sunk to the floor. I'm like, you are kidding. So I don't know if you got sent to a wrong room. Some people got in, most people did not. I have no idea what happened. But I think that can be prevented. Now, the big win that day is this was recorded.
While taking steps to support the rupee and boost dollar inflows. Bitcoin is currently the talk of the town as traders eye the $60,000 level after a volatile week. Keep a close eye on the U.S. jobs data coming up, as analysts suggest there is still upside.
To do the analysis. February is an up month. March is. Does it change your point of view if you knew that June was almost cool, right? So that worked, which means it works for the first time in like a year. So it worked. It worked. So we got to expand that out. So you'll have access to all the coaches will be here. Access to all their recordings will be here, separately and organized. We'll have courses, but actual courses built in. But remember, if you click this, it just takes you to Investor Bootcamp. So I'll move it over there so we'll actually have embedded courses that you can unlock through the rewards program or just go ahead and pay for, so on and so forth. And so very soon, you're going to learn how to link and level up. Cool, right? Again, most of you will lower your monthly cost down to 50 to 90% off. You'll get cash rebates from your spread to make trading cheaper. You'll get an equity boost in your account to make leverage cheaper. You'll get my chart templates. You'll get active trader status. You'll get all the upgrades unlocked as you level up, and other bonus things, chart templates, courses, and even I invented sort of an insurance policy along the way to prevent sort of lapses during periods of slow markets and all that kind of stuff. It's very, very sophisticated, and that program is free. So I'm going to save you money on your subscriptions. I'm going to save you money on your trading. I'm going to save you money on your leverage. I'm going to give you charts, level ups, courses, special events, and even a few other things that I haven't even built yet, but is on the to-do list. And all of that's for free. If you can think of anything else, I couldn't think of anything else that I can give you. I'm giving you everything. I spent hours brainstorming things I can do for you. So I hope you wake up in the morning and you feel like you have an advocate on your side. I'm your trading advocate. I want you to win. So, cool Mo D.